Okay, hello everyone. My name is Ben and I'll be taking today's workshop. This will be the first of our summer workshop series for the Lancaster Investment and Finance Society, and today we'll be covering portfolio allocation strategy pitch. I'll go through in detail what this is and what we're doing, but before we kick off, I just want to go through a few quick housekeeping rules. Please keep yourself on mute if you're not about to speak. If you are, then please do unmute yourself. We want to make this as interactive as possible. It is a workshop, so if you have any questions, either put it in the chat or just unmute yourself. And don't worry if you're cutting me off, just unmute yourself and ask your question, okay? If you're watching this as a recording and you do have a question, my email is in the bottom right of the screen. You can email me anything you'd like to ask, or if you have a question, you can also email me after the workshop. So without further ado, I want to get started. And so what is portfolio allocation strategy? So let's start off with a portfolio. A portfolio is a combination of different kinds of asset. By that, I mean it can include different types of stocks. So for example, what we do in the investment fund at university, we would pitch a single stock to you, and then would decide, okay, is this a good investment? A portfolio can include lots of different stocks. It can also include different types of assets, which can be bonds, it can be commodities such as gold, silver, oil, and you can also include alternatives such as real estate. So the idea of a portfolio is to kind of put your money into a lot of different areas and find the best places that you think have value in them. Okay. Now, an allocation strategy of a portfolio is kind of what I mentioned here, with allocating your money into different asset classes. And the strategy behind it is deciding, okay, which one's going to make me money, or which one am I going to put my money into to defend my money. So in case there's a downturn, which we're in right now, how am I going to kind of use a strategy to protect my money so it doesn't lose too much value? And finally, the pitch part of it, it's self-explanatory. I'm also going to go through basic points on how to kind of pitch your ideas when you're presenting a portfolio strategy, and how you kind of relay that information so anyone can kind of understand what you're thinking behind that. So there's two basic approaches that tends to be used when you're presenting a pitch of a portfolio or any kind of investment strategy. And there is the top-down approach or the bottom-up approach. Now, I tend to use the top-down approach, but if you want to use the bottom-up approach, it is the opposite of what I'm about to explain to you now. So the top-down approach starts off with global factors. So this can be anything to do with what's going on in the world and where can you find value right now. So this can be anything to do with, for example, the country politics. So let's say in the US, what Trump's kind of doing, for example, or it can also do the state of the kind of economy of the countries. So for example, if there's a war in a country, it might be risky or more risky to invest that kind of country. And then when we go into country specific factors, those are more narrowed down. So it can be the basis of what are the consumer trends, any kind of policies that the government's running, what are kind of the GDP and the stats of the economy in the country. Bringing it down lower is the sector specific. Now, this is a much more narrow, and this is a much more specific strategy that you follow here. By sector, I mean anything that is financials, consumer cyclicals. So those are products that you would buy cyclically throughout the year. Anything to do with, for example, utilities. So it can be a variety of different groups of kind of assets depending on what sector they are in. And then finally, you can actually bring it down to the lowest level, which is the stock selection. Now, this can be just the asset itself. So it can be an equity or a stock. So for example, talking about a company on its own, or it can be other assets, such as I mentioned before, bonds, gold, silver, oil, etc. And this is the strategy that I tend to use when I go through a pitch for a portfolio. But as I said, if you want to do a bottom up, which is the opposite of this, it will be the other way around, and you would start with kind of low levels. So for example, the stock, and build your way up towards your thinking throughout this triangle. Now I'm going to go through step by step of how this kind of looks from a top-down approach. So first of all, as I said, we kind of look at the macro overview of what's going on. Let me just get the chart. There we go. So this is the S&P 500, and just by the way, just to mention, the date on this presentation is from before December 2019. So the numbers here are going to look much better than we have right now in the economy and in the stock market. So it was kind of a different world a year ago when we pitched this. But at the time, the S&P 500 was reaching record highs. And in this pitch, we were questioning: is the US market overbought? Is the prices that we're seeing in the US market too high? We also had a look at the kind of statistics of what the Fed's doing. That's the Federal Reserve in America. And you can use the Federal Reserve to see if they're changing rates, interest rates on loans, and how that's kind of going to affect the economy. And if we don't expect the Federal Reserve to change the rates, then we can expect the economy to keep growing unless an unexpected event happens, such as what happened now, a global pandemic. And finally, we also looked at futures. Futures are basically a type of instrument that are kind of trying to predict a value in the future. And here again, this is focused on the Fed's decision. And according to this data, we weren't expecting much from the Fed. This is kind of a more quantitative side of the story. And by the way, don't worry if you don't understand every single kind of detail that I've mentioned here. Do ask me if you want me to clarify any of it. But the idea is that we're kind of looking at the overall country, the overall kind of feel of what's going on in the country, and seeing, you know, where's the value and how risky it is to invest here. So what we can get out of this quantitative side is it's looking good. You know, it's still growing, the economy, and at the same time, there are, you know, some thinking about maybe it is overbought, maybe there is going to be a correction. So there's a slight sense of warning there. Then we look at the qualitative side, which I mentioned before about the politics mainly here. And of course, when we're investing in the US, we look at what Trump is saying, because his kind of policies and speeches affect a lot of things in serious ways. And we need to analyze this quite closely and see what he's expected to kind of say, and what kind of decisions we expect to see him make. And that's very important to keep an eye on. As much as it's not very numerical or financial, it will affect your investment, and it is something that you need to keep a close eye on. Now, this is just the US, of course. If, let's say, you're investing in Brazil, then you will need to look at what the president's doing there, and other countries, again, what the leadership is doing in those kind of countries, and how that's going to affect an investment in a portfolio. So then we follow up with an analysis of what our portfolio will look like once we are investing in all the items that we chose to invest in. And here I'm comparing a portfolio on the left, sorry, a stock on the left to a portfolio. And what the idea is basically a comparison of a portfolio to an asset that I'm going to invest in a portfolio. So let's say I have a portfolio, as you can see on the right, that is mainly invested in the United States, which is why we were analyzing the United States so much. If I was going to invest the item on the left into that portfolio, where the United States is much less covered, much less, then we'd expect the portfolio itself to reduce in the amount of weight that it has in the US. Now, this is kind of important to look at, because if I, for example, here say that I think the US is risky and I don't want as big of a position as I have there now, then I can look at an asset that is such as the one we have on the left here and say this is a good asset because it will reduce our position in the US, put it in my portfolio, and it works perfectly. So what we're trying to do here is basically see how the new asset that we're putting into the portfolio, how that's going to affect the portfolio and change our position and allocation strategy. And here we have a few charts. This is, I'm kind of narrowing it down towards the sector level that we talked about. And these are just a few ideas that you can look at. One of them here is looking at how the money flows. When you're talking about portfolios, you look at money flows. So how much money has flown in or out into a certain sector or asset. Here we're looking at equity, which is companies, and fixed income, which is bonds. And as you can see here, equities have been having a lot more money flowing into them than bonds, which is an important thing because that means that's where I kind of want to put my money, because those assets are going to be going up in value, whereas fixed income has less flows, so maybe they're going to be worth less. We also can look at large caps in terms of equities. So how big is the company? Large caps are usually above $10 billion of value. And then you have different sections, so mid cap, small caps. They're just different kind of categories in terms of the size of the equity. And as you can see here, large caps at that time were dominating by far. So again, that's something to consider to invest in, looking at stocks or equities that have the kind of best inflows of money. And finally, here we're looking at a provider, which is UBS in this case, and they are kind of having quite a high inflows of money in their financial providers. So this is kind of considering where should we get our assets from. And then moving on to industry or sector, then we can break down our portfolio into which kind of sectors we are spread across. And right now, this is actually a very important picture to look at, because right now, as you know, we're in a recession and a lot of sectors are not doing that well, whereas other sectors are doing much better. And so here, if I was making a portfolio, I would quite carefully look at which sectors I expect to perform really well in this pandemic. So I would say most likely that is technology. As you can see, we're speaking through technology right now, and the demand for technology is ever more increasing. And so technology would be a sector I'd want to invest the most in. Whereas on the other hand, for example, financials have not done too well. So I wouldn't really want to put too much money in financials at the moment because it's doing badly. But this is just kind of an example. What I'm trying to get here is you want to show your thinking behind which sectors you've invested in and by how much, kind of where you're trying to position yourself. And so for this kind of pitch that we did here, we were going to invest in the utilities sector. And here we just compared on the graph the stock that we were invested in compared to the S&P 500, and just showing how it is outperforming the S&P 500, that kind of sector. And it would be a good sector to invest in as it's historically performing well. Now, before we go on to the narrow down of the stock, I'm just going to go through the basics of a portfolio and what kind of points you want to look at. So here, I'm just kind of summing up what I just said in the last few slides. So first of all, you want to give your portfolio a name. And this portfolio that we're investing in here is the Global 1200 Utilities Sector Index. And basically that name summarizes that we're invested in stocks that are to do with the utilities sector. And it tells us 66%, 66 stocks are in this portfolio, and it mainly is large and mid-cap companies. And also another point that the portfolio focuses on is country, and that is the US in this case, is why we talked about the US so much. And this portfolio is focused, has a weighting of 61.4% in the US. And then you can look at kind of the structure, what kind of assets are inside the portfolio. We will get onto this a bit more in later on in the presentation, and also what kind of technique you use to track your benchmark. Now, this is an important point. When you have a portfolio, you usually select a benchmark. Now, a benchmark is a index, such as maybe you've heard of the S&P 500 or the FTSE 100. These are basically indicators of how a group of assets, or a group of assets, basically how they are performing and what they're worth and what you expect them to be in the future. And you want to compare yourself to this benchmark, because if you have a portfolio that has a certain objective, then you can compare how well you're meeting that objective. So for example, here, if I was going to make a portfolio investing in utilities, I'd use the S&P Utilities Sector Index to compare myself to that index and see how well I'm meeting this criteria. Now, with a portfolio, there's two types of investing. There's passive and active. Passive is very simple. What you're basically trying to do is follow an index or your benchmark as closely as you can. So if I was going to say I want to make a FTSE 100 portfolio. I'm going to try my best to make the stocks and everything that's in there to follow it as closely as it can, that index. Okay, and active is a little bit different. They're not just following the index, they're actually trying to outperform it. So if the FTSE 100 was going up slowly, I'm going to try and strategically allocate my assets so that I do even better than that. Or let's say the FTSE 100 is going down, so it's losing value. I'm going to try and lose less value, and even better, I'm going to try and make money. Okay, that's kind of how that works. We've got a question. Do you have any recommendations of websites where you can find those industries or macroeconomic information focused on investments? I do have some websites that I recommend to you, and one is FinViz. I use it a lot. It's a free website, and it's a filter website, so you can basically you can filter down different kind of data points and economies, looking at kind of where the value is and where you want to invest. It's also got kind of a performance heat map where it shows you the whole world, and it tells you in the world where kind of what's performing well and what's not in kind of a colorful sense. It gives you colors, green, red. So it tells you how well, for example, the US is performing. You can compare that to, for example, Brazil. It also gives you a heat map of different sectors, so I can see which sectors are doing well right now, which are not, and it's kind of a visual way of looking at it. So it's called FinViz, but I'll put it in the chat now so you can see. There you go. Okay, and we have another one. Can you further discuss the reasoning for investing in equity over debt, and more about the correlation and long-term performance? So I'm gonna focus on presenting portfolio for now, but if we have time at the end, I will answer that question for you. But I'm just going to try and focus on how you present the portfolio first, and then I'll tell you about different kind of strategies at the end, just so that we don't confuse people. Okay, so we're looking at the kind of portfolio overview now. We have some main points here that you should include when you're presenting a portfolio, and that's growth performance or kind of comparative returns. Now, growth performance is, I just basically stick on my portfolio's historic performance and how it's performed throughout, and have also the benchmark on this, so I can see how correlated it is, how much above I am. And you can use this to, depending on what your strategy is, are you an active or a passive investor? I'm trying to kind of see how, in relation to the benchmark, I'm performing. Comparative returns is very similar to the graph on the left. The only little difference is I've kind of combined the two together. What I've done is basically I've used the benchmark as my base. So the percentages there on the comparative return is the percentage compared to the benchmark. So let's say if I'm 10% above my benchmark, my portfolio is performing 10% better than the benchmark. So the benchmark might be actually going down. I might be going down as well, but I might be going down 10% less than the benchmark. So that's what you want. So when you're an active investor, comparative returns chart is really good because you're basically just trying to get that number above the 0% as much as you can. Whereas the passive investing, this chart is kind of less relevant because what you're trying to do is just get that percent to be as close to 0 as possible. You're trying to hit that index, that benchmark, as close as you can. So more the left chart I would use for a passive investing, trying to get that line exactly on the same as the benchmark. Other things to look at is we're not going to talk about replication methodology, but it's very basic. It's how you what kind of assets you're buying. Is it physical, or is it kind of a secondary version? It's a derivative of the asset that you're trading. How is the dividends paid? So are you paying the investor from your portfolio when you get dividends from a company? Are you just giving it straight out, or are you reinvesting it into the portfolio? Very basic things such as when your portfolio was founded, so when you started the portfolio. That's important because if it's an older portfolio, it might have better funding, it might be more stable. So when on the other hand, someone might be looking for a kind of newer portfolio, something that's different to everyone else, what currency it's in, obviously, and finding on the bottom left the old cash machine that's showing us are kind of admin fees. If you invest in a thing called ETFs, which is exchange traded funds, it's basically a portfolio that you can buy, and it's actually you can buy as an everyday investor because the prices are spread out so much. It's easy to buy for anyone, and you have an admin fee for portfolios because someone has to manage that portfolio. Now, for a passive portfolio, that fee is quite low, because in a passive portfolio, what you're really doing is kind of just reweighting the portfolio. You don't have to do much. You just kind of have to make sure the portfolio is very similar to the benchmark. Whereas an active, they actively try and come up with strategies to outperform. So that's a lot more work from a human being. And finally, I've just put there the top holdings. So what stocks, in this case, what stocks I've got most of my money in. So I've got a question: why JXI over other ETFs like XLU and VPU? Seems to have much higher expense ratio. Yeah. So this was about a year ago that we did this pitch, and what basically we're asking here is we invested in an ETF called JXI. This is the JXI ETF for utilities. Okay. Now I'm guessing the XLU and the VPU are other ETFs that you can invest in. And at the time, the expense ratio, which I talked about with how much fee you have to pay for the management, at the time that looked like the best one. And also we have to keep in mind, we were trying to get a portfolio that's been around for around 10 years. So here it's actually been 14 years. And that kind of portfolio was mainly just with BlackRock in the utility sector, and BlackRock clearly has a higher expense ratio. Now, XLU and VPU ETFs I'm not actually familiar with, so I'm not sure if they are better to invest in, but at this time we just chose this ETF. I hope that kind of answers your question. It's been a while since I've pitched this, so I can't remember the other ETFs that we considered. Anyway, so moving on. So net assets, that's just basically how much money you have in the portfolio. So here we have $190 million dollars in this portfolio, and this portfolio we used the benchmark of the S&P Global Utilities Sector Index, basically. And then, yeah, as I've already kind of mentioned this as well, how many assets you've got in your portfolio. These are some of the basic metrics that I've got on the right, and I'm going to go into more complicated metrics as well later on. Price to earnings ratio is how much the stock costs per share compared to how much you're earning, how much the company's making per share. And this number is kind of when it's lower. It's a relative valuation. You want to compare this to other kind of portfolios that you might invest in. Basically, when it's lower, it's said to be cheap. It's said to be a good investment. When it's higher, it's said to be a expensive investment, but sometimes called value at the same time. Equity beta. Now, this is an interesting metric to look at, and this is 3 years. So what a beta is, it's basically a number that tells me how it's performing relative to the kind of general index. So if I have, let's say, Apple, and the Apple share price is performing a lot better than the NASDAQ, which is listed on the NASDAQ index, then that means the beta for that stock is going to be much higher than 1. Okay, so let's say the NASDAQ's going up, Apple's going up a lot more, the beta is a lot more than 1. When it's 1, that means my stock is kind of the same as the index. It's kind of, when the index changes, my stocks change the same way. And if it's less than 1, then my stock actually changes less when the index changes. So if the index goes up, my stock will go up less. Whereas the other way around, when the index goes down, my stock will go down but less. Okay, so it kind of looks at how relative to the general market, how my stock moves. And this is the same with the portfolio in relation to that. But this kind of beta is only in relation to well, actually, no, you can use it in other assets. So you can use it in a general portfolio. Price to book value is another ratio. It's similar to price to equity. Well, it's not similar. It's a type of relative ratio that you can use. And it basically looks at the price of the stock compared to the book value of the stock. So book value of the equity. The book value is basically when they release their annual data or financials, and it can be quarterly as well. They give you a number at the time in that financials. We're trying to compare how much the price is now compared to that. And the standard deviation, that's more of a mathematical term. It basically tells us how much the price varies of this portfolio, how volatile is it. And this is kind of what we use as the index for risk. So if this number is high, then we say the investment is more risky. And then finally, obviously, we have the country coverage, which countries I'm in, and this is kind of a more visual way of showing you where we're invested in, and you can explain why. So going to the kind of more the stock now. So we look at, it's important to show what holdings you have. And when you're presenting a portfolio, make sure you talk about what holdings you have now, what holdings you've had, and what kind of stocks or assets you've taken out and put in, and why. So what strategy have you used throughout time, how you've changed your position and why. That's very important to kind of explain that and your thinking behind that, and how are you finding value. I've not got much slides on this because this was just one pitch, but if I had a portfolio for like a couple of years, I would talk about how it's changed throughout the years and how the assets have changed and compare them. So this is looking at a certain stocks called Next Era, and this is a relative valuation. What that means is I'm basically using different kind of numbers to compare it to other companies. Okay, you can see Next Era at the top left in the light blue, and then down in peers you have Southern, Duke Energy, and Dominion Energy. And all the numbers that we see here are different kinds of metrics that we look at to compare the stocks. So I'll just start off with the first column. I'm going to go through all of them because these are a lot of different metrics. You can take a screenshot and Google some of them if you want to learn more about them. I'll just start with the first one, which is the forward PE, price to earnings ratio. It's like the price to earnings ratio I explained before. The only difference is that it's forward, so the earnings is what we expect maybe in a year. So this is fiscal year 1. The net one right to the column right to is fiscal year 2. So how much earnings we expect in fiscal year 1. This is kind of a forward-looking future ratio, and which kind of relative valuation you use, which metric you use out of these is up to you. What you see appropriate for the company, what you think is creating the most value for the company, is important to make your mind up here. So I don't actually know Next Era that well, so I can't actually give you an answer here, which one would be best here. But the general consensus is to look at these ratios in general and compare them to their competitors. And also it's important to do an absolute valuation, which is not like this is the opposite of this, in fact, where instead of comparing the company that I'm about to invest to other companies, instead I just value the company on its own based on its cash flow generations, how much value that company is creating in the coming years. So that's another way of deciding on a stock, but this is just equity, so this is just stocks. If I was going to invest in, for example, oil, I'll look at completely different things. And yeah, next year we'll also kind of look at its technical performance, so how it's performed in terms of price throughout the years, and what that looks like. And there are some metrics down there which were researched just relating to the company itself, so just going into detail of the company. Another big topic that we follow, and we follow this in the Ghosal Investment Fund at university, is the ESG. It stands for Environmental, Social and Governance. This is kind of the ethical investing world, and it's becoming more and more important, especially now when we have finite resources due to a pandemic, and so we have to think about where we put our money and how sustainable that money will be. And more you can see in statistics that the performance of ESGs is doing much better than stocks that are not ESG. So when we look at ESG, they usually either give a score for ESG out of 10. So this portfolio is an ESG of 8.1, and they also sometimes give you a rating. So it can be like an A, B. There's a double A here. I think it can be, the ratings can be similar to credit ratings, like AAA, AA, single A, etc. They also give you a percentile. So if I compare this portfolio to other portfolios that are similar to it, with kind of a similar strategy, how well have I met the ESG criteria? And finally, the ESG coverage, which I'll talk about in the next slide, is there's basically a minimum requirement for a stock to meet ESG. And here in this portfolio, 99.8% of the assets that are in the portfolio meet the ESG criteria. What is the ESG criteria? I'll get back to that in a second. It's the next slide. As you can see here, I've actually broken down the ESG into all the different assets that we have in this portfolio, and this one's actually out of 100. And the ones that are in green are kind of near 80 or above 80. The ones that are in yellow are less than 80. So those are the ones that are kind of bringing down the ESG score. And you just want to kind of look at which assets are bringing down the ESG score maybe, and then explain maybe you've invested in that stock. Yes, the ESG is lower, but the kind of value that they create might be worthwhile investing in them anyway. So here we go. The minimum requirements for ESG can contain some of the points below, and the minimum basically just means that if they touch any of these kind of items, there are more items that are included. So there's some more criteria. I've just included the kind of first four. There's a long list of them. And if the company does anything to do with non-ESG items, they straight away don't make it onto ESG. But being minimum on ESG isn't that great either. It's just the minimum. It's just not doing the bad things, but it doesn't usually include things that are used worthwhile for longer term. So we got a question: what they use for ESG metrics and why? So when we invest in Ghosal, Thomson Reuters Aecon has a really nice ESG calculator that for each stocks gives you a metric based on what the company does. Now I've not actually used anything else, so I know that there is a lot of resources out there on the internet. As I said, it's becoming more and more important, and there is an ESG, I think it's called ESG graph maybe, where it tells you basically a long line of what kind of ESG investor you can be. It starts off with the minimum ESG, which I've explained here, and there's different steps of being a kind of sustainable investor, and it goes along the line, and then towards the end it's like the really serious investors who kind of just focus on maintaining the future. So that's something maybe to Google and look into. But at Ghosal, we just make sure we at least meet the minimum requirements when we invest. So nothing that we invest in Ghosal is not ESG. We have to invest in everything that is ESG. I've kind of done this already, but it's important to look at the relative performance to the benchmark and look into it more technical. So at times, for example, here in 2019 February, I did pretty well. I got 14% in this portfolio. Why is that? What did I do right? What kind of strategy did I adopt? Or beforehand, when it was below zero in like 2018, why is that? What kind of strategy did I use there? How can I kind of change my performance so that I carry on making active returns? Another important point to look at is currency, and that's very important when you're investing across the world, because for example, if we're Ghosal, we're a UK-based investment fund, but we invest quite a lot in the US, for example. Now, that's great because there are great companies in the US, but once I've made my money and I want to sell my shares and get my money back in pounds, I'm going to have to exchange the currency. I can't just keep it in dollars. So it's important to keep an eye on the kind of currency risk. And this is a whole, in banks and kind of treasury departments, this is a whole kind of job that someone has where they focus on making sure where the money is and how much there is, and they use different kind of instruments to make sure they exchange their money in the right value, so that you don't lose a lot of money when you're exchanging your returns or how much money you have. And here what I'm doing is I've got the portfolio risk in blue, so how much currency I have in the portfolio, and the ETF. So in this case, that's like the new investment that I'm about to put into my portfolio. And I'm looking at comparing the two together. If I invest in this new stock or ETF, how that's going to affect my portfolio. So here, this ETF has a much higher presence in the US dollar, whereas, for example, in pounds, it has a much less presence. At this time, I think we're trying to increase our position in dollars back a year ago. Again, it's just use this method to show how it relates to your portfolio and how it's going to affect when you invest in this overall portfolio allocation. I want to skip past this. This is a relative chart, but basically here you're comparing the benchmark to your portfolio. So beta we've talked about. I'm just going to talk about how you kind of compare when you invest in something new. So the MSCI World is our benchmark here, which is the light blue, and the dark blue is our portfolio, and the red is a new investment. So the MSCI World will be 1 because that's our benchmark. That's what we're comparing to. So that's going to be 1. Now we're comparing our portfolio. Our portfolio is near to 1, so we're almost there. We're trying to be passive, so we're trying to reach that number 1. And our new investment is actually much lower than 1, so it will actually bring down our portfolio if we made this investment in terms of beta. Another important metric that we look at is correlation. Correlation is kind of how when they move, so when the price of something moves, how similar the movement is in someone else's price. And basically, what you're trying to do with a portfolio is you're trying to diversify yourself. What that means is I'm trying not to invest in just one thing. Okay, well, this will depend on your strategy. But if you're a kind of a retail investor and you just want to make sure you make money and you also are kind of getting a good return for the risk that you take, you want to diversify yourself. And what that means is basically I'm trying to get as much return compared to the kind of risk or the volatility that I'm taking. And if I just invest in one thing, so just invest in, for example, technology, the amount of risk that I'm taking is going to kind of stay the same because it's the technology sector. The risk in that technology sector is kind of constant or the same that is in. So it doesn't matter which technology I invest in the technology sector, the risk is going to be very similar. And I can't really get rid of that risk or reduce that risk, but I might get better returns. You never know. Whereas if I diversify my portfolio, see if I invest in other stuff as well, maybe gold, for example, which is a completely different performance to technology, I'm going to reduce the amount of risk that I take, but at the same time, I might still get the same return. And that brings me on to the last ratio here, which is a Sharpe ratio. And that is basically a ratio that tells me how much return am I getting for 1 unit of risk. So at the top of the equation, we have the return minus the risk-free rate. So this return is without risk-free rate, and divide it by the variance. So what I'm trying to do is basically see how much risk is going on, how volatile is the investment compared to the return. Okay, we want this number to be as high as possible. So as you can see here, the stock that I'm investing, which is red, that number is pretty high. 3 is really good. So I'm getting 3.7 units of return compared to 1 unit of risk. And again, it's important to compare this to your portfolio. How risky is your portfolio? And by investing in this new stock, how that risk is going to change. Other quick metrics that I'm going to quickly go through. Still got 20 minutes. So we usually put together a total risk. Thomson Reuters again has a really good system for this. It basically just balances out the different kind of metrics. It's a system to value risk. Another thing is return. That's just how much return you get. Volatility, which I talked about, is how much risk you're taking. Now, another metric that we use is the Sortino ratio. This is similar to the Sharpe ratio. The only difference is the Sortino ratio only looks at downside volatility. Okay, so volatility can be up and down. Sortino only looks at the down, so anytime it goes down. Okay, and this basically looks at how much return we're getting for the downside risk. Okay, again, we want a higher number here. Tracking difference, that's basically a kind of ratio of estimating how far off we are from our benchmark. Sorry, I just clicked that. How far we are from the benchmark. So if I'm a passive investor, for example, I want my tracking difference to be as low as possible. So I want to be as close to the benchmark as possible. When I'm an active, this number might be higher because I might be percentage off the benchmark a little bit. I might be performing differently. Okay, and it's kind of just an indicator of how different we are compared to the benchmark. These are other metrics that you can use when you look at a portfolio. Price to sales is basically the price of the portfolio compared to the revenues that the equity generates in the portfolio. Price to book I've already been through. Price to cash flow is the price compared to the cash flow that the stocks generate. Dividend yield is how much dividend the stock pays compared to the price. Price to equity forecast, that was the forward PE. It's basically how much earnings we expect them to have in a year's time. And trailing is the opposite of forward, it's the historical. Actually, no, sorry, no, trailing is adjusted. So basically, companies release their kind of financials every year, okay? But they also release quarterly financials, which are almost they contain almost as much information as the yearly, not as much. There's certain things that they don't include, but a lot of important points are in there. So what you can do is you can go quarter by quarter. So let's say I start off with Q1. I add on the numbers from Q1 to the previous year's data, and I take off from that data the last year's Q1, and that way it's trailing. So I'm going through the year. So basically what this is useful for is I've got data that is no older than a quarter of a year. And some say it's more accurate. Again, it's personal preference, and you just got to play around with these numbers and see which ones work best, and it will be different for different sectors and industries. Finally, the last thing that I'm going to talk about is value at risk. And value at risk is a model that basically estimates how much set investment might lose at a certain probability. Okay, so what that means is basically if I'm going to, for example, wait 1 week invested in this portfolio, which is the second kind of group column down at the bottom, at for example 90% confidence, which is the orange line, what percent value my loss is going to stop at 90% probability. Okay, and this is basically a good way to see how risky this investment will be. Okay, now we use confidence intervals because obviously no one can predict the future. This is kind of a probability-based approach to see how much loss I could be coming up with on this investment. And on its own, it's useful, but it's much more useful if you compare it to something else. So we have a portfolio here. We have another portfolio that's similar to the previous portfolio, and I'm just kind of comparing the percentages and seeing which investment is going to, or is likely to have a bigger loss. Okay. Now, obviously, this is just the chance of loss, but you can't see the return here. But the loss is if you're trying to be risk averse, and I would choose the portfolio out of these two, which are less likely to kind of lose a big amount of money. And finally, I always like to sum up with a SWOT analysis, which is strengths, weakness, opportunities, threats. It's a good way to kind of finish a pitch. So that if someone forgot something or didn't pay as much attention to a part, then they can, still hear that bit quickly and remember what you said. And it's a good way to kind of summarize anything that you said at the end. So that is it from me. If you guys have any more questions, I'm going to be around for the next few minutes. Please type anything in the chat or just unmute yourself and ask me if you have any questions. If you're watching the recording, again, my email is at the bottom right. Please do email me if you have any questions. But if you don't have any, okay, we have one question here. So what are the benefits of being a passive investor? It seems that being an active investor is relatively better as you aim to outperform the benchmark while passive only aims to follow it. Okay, so this kind of is, in a sense, risk preference. So passive investing is, I would say, much more kind of computer based in a sense. So it's very low admin. So the person doesn't do much. They just kind of make sure it's working and make sure that the stocks are right, that are in the portfolio, whatever's in the portfolio is right. Whereas active, it's a lot more technology, strategy, and implementation. And there's actually a lot, hedge funds do this a lot. So there's a lot of different types of hedge fund strategies that they follow. One of the popular ones that you have been hearing more and more is quantitative, where they use kind of computer technology, which is very different to what it used to be, where you just have a bunch of guys, smart guys in a room trying to figure out where to find value. Now you have a bunch of computers in a room that you have a few people managing those computers, and they put in a load of different algorithms and kind of statistical strategies to make money. Now, which one's better? As I mentioned, personal preference. I'd say active is more risky, but then with risk, you will have more return. Okay. An important thing to look at when you're investing, and this is what kind of wealth management works with. Wealth management is basically a kind of firm that manages rich people's money. They will talk to you and they will see what do you want from the future. So, for example, I'm not that old, so I've got quite a lot of time ahead of me, and I don't need the money right now. So I'm happy to take a lot more risk. So I might be, if I had a lot of money, I would be more than happy to invest in active, because I might trust the people or the strategy that they use I might like. And if I'm happy with that strategy and I'm willing to take that risk, I might be happy with that, and also I might get a really good return. Whereas let's say I am 60 years old and I'm about to retire, and let's say in 10 years time I'm going to need my pension, and the money that I have, I don't want to risk it. I just want to make enough money, but at the same time I'm happy to take a little bit of risk. Okay, so then I select a certain portfolio that I want to invest in, sorry, a certain index that I want to invest in. Let's say, for example, the S&P 500. I don't know, some index that you like, some index that you want to follow, and you can't just buy the index. So I go to a portfolio manager who manages a portfolio that follows that index, and I can buy into that. Now, the reason passive exists is because you could technically replicate the portfolio yourself, but the only issue is, let's say we have a stock like Apple, which costs, I don't know, over $1,000. I can't remember how much it is, but it's very expensive. Okay, and I might not want to buy one share of it. I might want to only have half a share, depending on how much money I have. So that's going to be a problem. The set amount of money that you can invest when you're replicating the portfolio yourself is set. You can't go below that. Whereas when you have someone else buying into a portfolio using lots of people's money, you're accumulating the money together. So that's why, for example, ETFs can be cheap, because a lot of people are accumulating money together. So basically, when you have an ETF, for example, which is a combination of loads of different stocks, you're actually buying just fractions, in a sense, fractions of shares of companies. But because there's a lot of money going into an ETF, it is still possible to do that. I hope that kind of makes sense and answers your question. We're just going to go back to that question that we had before. Yeah, so can you further discuss the reasoning for investing in equity over debt, more about the correlation between volumes traded and performance? Okay, so equity markets and debt markets are different. So when a company wants to raise money, so let's say I'm a big company and I want to have money, okay, I can either go and become public, and what that means is I can get investors from the public to put money into my company. That's the equity side. Or I can go to the investment bank and get them to release some bonds for me. So I've just got some noise coming. Sorry about that. So yeah, then I can go to the bond market and sell bonds. Now, bonds it's basically a different type of assets, less risky is the best way to put it. So when I invest in bonds in a company, I get a fixed return for those bonds called the coupon. Okay, so I get a fixed amount of money coming in. Now, with equity, the dividends, which is the cash flows from equity, is not fixed. It could be zero. They might not pay. They don't have to pay dividends. Okay, and the price of equity changes a lot more than bonds, and so they can be more risky. Now, at the same time, bondholders are higher up in the company's agenda. Okay, so we have a table, kind of hierarchy of different investors, and bond investors are much higher up. So when the company, for example, goes bust, the bond investors or the fixed income investors are the first ones or the earlier ones to get paid. The common equity, which is at the bottom of the list, are the last ones, and they usually don't get paid if the company goes bust. Okay, so in a sense, the reason that we invest in equity and not debt is because it's more risky, and with risk you get more return, and we are happy to take on more risk. That's what we are doing. We're an equity investor and aim for a better return. Also at the same time, valuing equity is a process that we at Ghosal are more interested in doing. But if it's bonds that you're interested in doing, you can find a lot of resources on that as well, and that's kind of a whole kind of new world, a different world to equity that you can look into. Correlation, it depends, the correlation between equity and debt. I'm going to be honest, I don't follow the debt market that closely. It will depend on the economy and how it's doing. Right now, when it's a recession and a sudden downturn, the equity and the debt are going to be correlated. They're going to be similar in a sense. So the prices of them are going to change similarly because no one wants to kind of invest. But it will depend on the economy, and I'm sorry I can't answer that in more detail. I have not been following the debt markets enough. And volumes traded, I know that in a sense of volumes traded, I know that the debt market has bigger volumes traded simply because the debt market is targeted a lot more by firms, so institutional investors, whereas equity is kind of less money inflows. Let's have a look. What else do we have? So, where can you find the recording? This chat should have the recording in it once we are finished. Yeah, the slides will be up here as on this chat. Do you use technical analysis when you form a portfolio, or you focus mainly on fundamental analysis? So yeah, this is an interesting debate. For those of you who don't know what technical analysis is and fundamental analysis, technical analysis is the fact of looking at charts. Okay, so I have a company, for example, Microsoft. I go on their price chart and I look at how that price is going, moving around. Okay, and I use different kind of techniques, a very basic techniques such as just using lines. So a thing called resistance or support. Those are just basically lines where the price kind of stops and changes direction. Or I can go into much more complicated techniques such as harmonic trading, which are different types of patterns that are kind of different types of ratios using triangles to see where the stock has changed direction. And I can tell maybe a year later or half a year later where that stock price is going to move now. Okay. A lot of people don't believe in technical analysis, and a lot of people will use fundamental. Actually, I'll explain fundamental analysis. Fundamental analysis is basically what we did here. So all these kind of quantitative and qualitative values, looking at all the company itself relative to its peers, how it's doing, how the market's doing, how the economy is doing, etc., etc. So a lot of people will focus on fundamental analysis, and it is very important, obviously. And it's important to kind of, what you're trying to do is find value mainly. So you're trying to see, I'm putting my money into company A, is that going to be a valuable company? Is it going to generate money for me? Now, technical analysis, I think personally, is very important because yes, you can find value, and it's important to find value, but when you buy that value, when you put your money in that value, is also very important. So I might have a stock that I do a discounted cash flow analysis on, which is a type of valuation, and I say, look, this company is really good to invest into, it's really valuable. But looking at the price is actually way too high for this. It's all-time high price. So it might be good value, but right now, the money that people are paying for it is just not the right price. Okay, that's why it's important to do a technical analysis to see where we're at in the market right now. So even though this is going to bring me value, I want to put my money in at the right time. I want to get I like to say double whammy, so I get value and the right timing so that I can make the most money. Okay, so that's why I think it's important to also look into technical analysis. Technical analysis is not as complicated as fundamental, luckily, and it's actually quite a fun thing to learn, so do look into that. Okay, so how much attention do I pay to the PE ratio? For example, Apple has quite a high PE ratio right now, and whereas, for example, 30 PE would be more appropriate. I'm going to be very honest with you. Personally, I like to focus on value. Okay, so there's two things when we do valuation. Okay, we have the discount cash flow model, or the absolute valuation, and that's where we're genuinely trying to find value of the company. How much money is this thing going to generate for me? What would I put my money into? Relative valuation is just the PE ratio, the price to earnings ratio. That's called pricing. Okay, I'm seeing how much price someone's paying for this. Okay, compared to everyone else. So let's say I'm buying a house. That's when you do pricing most. I'm buying a house. The price of the house is usually relative to how much the other houses are that are similar to my house worth in that area. Okay, that's how the prices come up. Okay, the price doesn't always reflect the value. Okay, sometimes it might be a bubble or something that people don't know the true value of, and they just put a load of money into it. A good example of this is, for example, Hertz, which is a company that has filed for bankruptcy, but a lot of people are still putting money into it, and the price is going up because people think they just make money because other people are doing the same. But Hertz is not making any more value. It's not changing at all. In fact, it's probably doing worse off because of the bankruptcy hearings, but people are still putting money into it. So value and pricing are two kind of different worlds. And as I said, using technical analysis, using relative valuation, you need to get the pricing side right so that if you find value, you get kind of the right timing put in as well. So the PE ratio, for example, for Apple will be high because compared to Apple is at high prices right now, especially now that we're using more technology. And in the technology sector in general, the PE is high anyway. So when I say high in a relative valuation, suggest PE, high to what? High to compared to what? Okay, it's relative valuation. So I can't just whip out a number and say this is high. Okay, I have to compare it to other things in the sector, in the competitors, and then I can say compared to these guys, it's high. Okay. Only problem I have with relative valuation is it depends on what you compare it to. Okay, so Apple's PE ratio might be very high compared to, for example, a utilities company, but other companies that are even higher in PE ratio, well, relative to that, Apple's PE ratio might actually be quite low. So I'll be careful with using relative valuation, and I'll make sure that I compare my stock to companies that are very close to it, very similar to it. Now, I haven't actually been looking at the PE ratio for Apple at this moment, but you could say there is a bubble. When a bubble is kind of present, the best way to tell is looking at the company's values. Is this company making money, or is there value there? And comparing that to the price. So, for example, if the value, for example, Tesla, the value suddenly jumps up out of nowhere. So the price jumps up out of nowhere, but you can't see any more value in it, for example. So you can't see if the company's done anything different or any kind of anything is new. Then that's usually a bubble, okay? And that's kind of what you got to keep an eye on. Am I investing in value, or am I just investing in other people putting their money into something and thinking this is good? Okay, and so. Okay, so I want to finish. I've got one more question, but I'll answer that at the end. So I'm going to finish here because time is up. And so thank you everyone for joining us. If you're watching the recording, thank you. I hope you found it useful. And this was our first series of summer workshops. We will be having more throughout this summer, and we'll be covering a lot of different topics. As usual, please check our Facebook, Instagram to keep up to date. And thank you for coming, and see you next time.